So thanks so much for tuning into this earnings conversation. It could well be the talking point of the day today. Havells has come out with a splendid set of numbers. I won't even get into the year-on-year comparisons, but just telling you versus estimates. The revenues at 3165 crores. The estimates were 2627 crores on the Bloomberg terminal. EBITDA margins have expanded to 16%. Net profit at 349 crores. The estimates were 251 crores. So it's a very strong beat compared to what the estimates were and compared to what the corresponding quarter numbers were as well. Mr. Anil Gupta Johnson right now to talk about how did he see the quarter go by? Did he envisage this at all when we were speaking in October? And how does he see the outlook ahead? Mr. Gupta, good having you. Thanks for joining in. Hope all is safe.
All is safe. Thank you, Neeraj. Thank you. And well, I think you asked this question about October. October was the month where we, started off seeing a positive trend in the, in the consumer demand. And I would say, post lockdown, post COVID, there have been some structural changes in the market scenario. Second quarter was definitely a time when things were coming out of the lockdown. But third quarter, I think, quite a bit we saw normalization of demand scenario, especially in the consumer and residential segment. But also, we saw some tailwinds in the industrial infra, which was not doing extremely well after the lockdown. So that actually turned around in the third quarter. Though it's a small part of our business, about 25% of overall revenues, but that was in degrowth in the second quarter. That turned towards mid-teen growth in the third quarter. So some structural tailwinds were there. Of course, was also benefited by the fact that we had elongated Diwali because of Diwali happening in November. So festive demand continued. Lighting demand was also good. Also, because of the increase in raw material prices, so there were constant push towards price increases in the market. And we believe in the month of December we saw some sort of pre-buying also from the trade because of the impending price increases in the coming time. So could be a little bit of pre-buying in the third quarter as well, but more so some structural tailwinds in most of the businesses.
Yeah. So you would have been happy with the fact that switchgears, cables, and lighting, all three which were relatively soft in quarter two, have come back because the others were anyways doing well and it's been an extension. But these three segments in particular, you would have been happy with the performance. How does it look like in the current quarter or for the year to come?
As I said, all these three businesses have two different parts. Most of it is consumer and residential. The other one quarters is about industrial and infra. In fact, cable wires is almost 50-50. But in all these segments, we saw demand coming up. I think, to some extent, maybe, the consumers decided to finish their apartments, houses. More buying also happened in the third quarter. So from a real estate point of view. So I think there was overall improvement in demand in the consumer residential part. And as I said, things normalizing on the industrial infra side also helped quite a bit.
So the segmental profitability, largely because of operating leverage, because I distinctly remember you telling me specifically that some of the costs that were not a part of quarter one and quarter two, ad expenses, etc., will all come back. And you had said that those are good costs which will come back. But there is substantial uptick in segmental profitability.
Yeah. So and if we see the results of Havells over the last 3 or 4 years, we had been making investments in brand, in distribution, in R&D. So there was disproportionate increase in our SGA expenses as compared to the growth in sales because the growth was limited during the last 2 or 3 years. So we always believe that we are making the right investments for the future. So today, with growth coming back, we are now seeing more operating leverage. As you rightly said, the good costs have almost come back in terms of advertising and spending. Obviously, one had to make structural changes in the businesses. That is smaller costs, bad costs which were taken out. Those should not come back. And I think, most of the business uptick, or the margin uptick that you have seen, is coming out of operating leverage.
Okay. And Mr. Gupta, rudimentary question, but still asking you reckon that all of the raw material or the input cost increases that will happen or have happened would see a straight away pass through because of the demand buoyancy?
I would say that it will be a careful balance between managing market shares, demand, as well as taking benefits out of the reduced manufacturing expenses because of higher production. So I would say that maybe some part may be held back, not to pass on the entire cost to the consumers, but that should not affect the overall margin of the business because, as I said, operating leverage and reduced or efficiencies in the business is helping improve margins. So we would be very careful about what is the kind of price increase which needs to be passed on, because this has been an unprecedented cost raw material increase, and for consumer to immediately accept this kind of a change will also become difficult. Had it been over a longer period of time, it would have been possible. So I think it will be carefully balanced over the next 2 months.
Okay. ECD Lloyd's, Mr. Gupta, a case of market share gains or other factors, because that's seen a substantial growth. And I think people are now saying that what the Lloyd's read through would actually be true for the industry at large as well.
I would say that not only in ECD and Lloyd, but we have seen market share gains in the last 6 months in all our product categories. Some sort of supply chain disruption happened post-COVID. I think our distribution reach, rural reach, has helped us gain market share in many product categories. ECDs, fans, which is the mainstay of ECDs, but a sizable part of business are also water heaters and appliances. That has done extremely well. And good part is that the fans, which is almost 60-70% of the overall ECD business, has done extremely well in this quarter. Some sort of pre-buying also happened in fans because the season will come in the fourth quarter. So the dealers knew that the prices will be going up. So some sort of pre-buying happened. But mostly it is market share gains. And Lloyd definitely, it has been a journey over the last 2 or 3 years after the acquisition, because we had to move away from import dependence to own manufacturing. Since last year, when the manufacturing facility for air conditioners came up, we have seen market share gains, or I would say, recovery of market share, which we used to have, is now coming back. So definitely, I would say that we have done well in air conditioners, but also the new launches like the revamped range of washing machines and refrigerators that have also done well in the third quarter.
Again, just last couple of questions. One is that the belief is that your with the brand power that you guys have any which ways, the opportunity size in both AC refrigerators in particular remains very large. You've anyways spoken about market share gains there too. Do you reckon that 2021 could well be a year wherein the growth numbers in those segments really expand?
Yes, I mean, obviously the base was very low, but definitely we are looking at market share gains in washing machines, refrigerators, and air conditioners.
Okay. One last question, Mr. Gupta, and that is, again, just a thought that is coming from the 2 or 3 notes that I read in the morning about how, while it is a smaller part of your growth of your business, as you alluded to, a stronger growth in the infra-industrial segment would be core to the 2-3 year performances that people anticipate from you. Maybe you look at it differently. Can you just throw some color there? Would you reckon that for your overall growth to look robust over a 3-year period, the stability and the growth in infra-industrials would be paramount?
It is important because it's still a quarter of our business, and important part of the business. It helps our manufacturing facilities in a big way, because the manufacturing in the back end is quite common, with all the market segment will be very different. So it is definitely required, and overall growth of the economy also depends upon higher spends in the industrial and infra segment also, because that's the mood of the market. And I believe that combined with the government spends, as well as more manufacturing capex coming in the next few years, that should definitely help overall growth for Havells.
Okay, can I actually squeeze in a bit of an economy question here? A lot of people believe that we are entering a period of Goldilocks in terms of economic growth, with the next 4 quarters having some bit of a base effect advantage as well, but overall economic growth looking very, very robust. I mean, the term used is Goldilocks. Would you reckon, as you sitting where you are, that we could actually see this for India?
Well, again, I'm pretty much an optimist for India, and I feel that we may have slowed down in the last few years. But overall, if we don't look at the next 4 quarters, but we look at the next 4 years or 10 years, I think India has a huge potential. And the way probably the government is now looking at supporting manufacturing with, some sort of barriers, but also production incentives in many industries. I believe that, if manufacturing does well, India has a great potential to grow in the coming years.
We leave it at that, Mr. Gupta. Thank you so much for taking the time out, and congratulations on a good quarter.
Thank you. Thank you.
Viewers, thanks for tuning in to this earnings conversation with Havells. The stock is doing really well, and well, the management is confident about the outlook ahead.